Wow, what a day we just experienced in the stock market. Kind of reminded me of that Anchorman gif with Ron Burgundy, where he says, boy, that escalated quickly. We had the S&P 500 jumping over 2% to start the day. And then wouldn't you know, as the day progressed, all of those gains evaporated and just disappeared. We did end up closing higher by about 0.7% when it was all said and done. But it was a volatile day to say the least. In fact, all four of our major US equity indices had a daily range today that was beyond their average true range. And we could very well have a similar type of a situation tomorrow when we have Jerome Powell and company reacting to this morning's cooler than average CPI number to see what that holds for the future of interest rate policy as we head into 2023. So buckle up. We'll talk about all that in tonight's video. We'll then get into some sector analysis, some macro analysis, and then we'll do a trade application example on one of the world's largest publicly traded companies that's really just been aimless and trending sideways. And I thought it might be a good candidate for an iron condor. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's December 13th, 2022. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel, then go down below into our description area. Make sure you're signed up for our email distribution list so that way you can be notified whenever we post these videos. We'll also let you know at the bottom of those videos if there are any stocks in the S&P 500 giving us overbought or oversold cluster signals. In addition to that, we're heavy users of Twitter. If you're not doing so already, I would encourage you to follow me. My handle is @BrandonVanZ. And then last but not least, we do have a presence on Facebook. Feel free to join our group at that web address you see in the logo in front of you. All right, let's go ahead and jump into today's trade activity. And as usual, I've got the S&P 500 heat map pulled up here in front of us to give us a lay of the land. And today's big story, for those of you that hadn't heard it yet, we had a CPI reading this morning, and the inflation number came in a bit cooler than was anticipated, and the markets cheered that on with the hopes that if inflation is cooling to a great degree, that perhaps Jerome Powell and company won't have to be as aggressive with their interest rate policy moving forward. So we had this epic rally in the morning. In fact, we were up over 2%. By the end of the day, things kind of moderated a bit, and we ended up just higher by about 0.76% when it was all said and done. So in between the open and the close, we actually gave back all of those gains. I know the Dow for sure was down briefly in the afternoon, but we did have a little bit of a rally there for the final hour or so in trading to close still in the green here. And you can see most of the stocks did close in the green, but that gives you a sense of how volatile this day was, where we gapped up approximately 2%. The Dow was up 700 points, and then the Dow eventually gave back all of those 700 points before catching a little bit of a bounce at the end of the day. We'll see how we handle the actual Jerome Powell interest rate decision plus the press conference tomorrow. Remember, some people think that the day is over once the interest rate decision has come out and hits the press releases, but it's really the press conference that Jerome Powell speaks at within that next hour that becomes equally as important, because it gives insight as to how he and the committee are thinking about the interest rate policy and perhaps what their expectations are moving forward, where he answers questions from reporters and what have you. And so tomorrow is expected to be another volatile day if we didn't get enough of that here today. But in the end, as you can see, another promising day there for the bulls. Lots of green showing up, especially with some of our bigger players, like Apple was up about 0.68% today. Microsoft was up 1.75%. Alphabet was up 2.5% today. Amazon was up over 2%. So those are kind of your big kahunas. From the downside of the perspective, notice that Tesla was down yet again. That stock can't seem to get out of its own way. Perhaps a lot of concern about Elon Musk and how much time he's spending at Twitter these days and time not spent at Tesla. And so that stock was down another 4% today. You'll notice the market cap is right there around $500 billion now. And remember, it was once a $1 trillion company, so its square would have been as big as how Amazon looks right now, as opposed to the ever shrinking square that Tesla seems to be going through here, especially here in 2022. You'll notice that healthcare had a little bit of a struggle today. United Healthcare is the world's largest publicly traded healthcare company. It was down 1.4% here today. Johnson & Johnson is the second largest. It was actually up a touch today. But you'll notice that there were a number of these other players that were down today. Amgen, AbbVie, Bristol Myers, Eli Lilly, CVS. There's some pretty well-known healthcare entities that did close the day lower here today. We did have a big news story out of Moderna. It was up nearly 20% today. Remember, that was a company that was popularized during the COVID time period for having one of the COVID vaccines. But apparently they've been teaming up with Merck and had some breakthroughs in some cancer drugs here today as well. So that was kind of on the flip side there of some of that bearishness we saw in healthcare otherwise. I would also say that consumer staples seem to be a little bit more prone to red squares and rectangles. In other words, a little bit more selling going on there. Procter & Gamble was down a touch, Walmart down a touch, etc. They weren't big moves, but that's fairly typical behavior when you have a big risk on day like we had here today. Most of that money is going to flood into areas where it's perceiving a little bit more exciting opportunities than consumer staples and healthcare. So maybe that played a little bit of a role there. It does seem like energy bounced back a touch here today. Not all of them closed higher, but still a fairly decent day for some of those energy stocks. Chevron was up over 2% here today, so pretty nice move there. Let's see, what was this one? Halliburton was up about 7% today. That was actually the second best performing stock in the S&P 500 after Moderna. And then I think Match Group was number 3. And you can barely see that one here because it's such a puny company. It's only $13 billion. But that's the company behind all those online dating apps. And it was up about 7.6% here today. So a pretty strong day from that perspective. Looks like there was a smattering of selling in consumer discretionary today. McDonald's and Starbucks and some of those hotel stocks that had been quite hot. They took a little bit of a breather here today. So all in all, I would say it was an extremely promising day, a very bullish day. However, it sort of ended with a little bit more of a whimper than the bulls would have liked, considering the fact that we gapped up 2% to start the day, and we ended up finishing higher by less than 1%. It just kind of left a little bit more to be desired. And perhaps tomorrow, the bulls will get that. If Jerome Powell comes out and says, I think we've done the job. Victory is ours. We've defeated inflation. I don't plan on raising interest rates anymore. Then I'm sure the stock market would fly higher upon that. However, I highly doubt he's going to say anything remotely close to that. Instead, I'm sure he is going to say that they remain vigilant against the fight against inflation and that they will continue to do the job until the job is done. Now, he might loosen up some of its language, and that might still appease the bulls, but I have no doubt that he's still going to want to kind of send the message that he's not just stepping aside here, that inflation is still a very important enemy or challenger at this moment, despite coming in a little bit cooler than was expected here with the CPI number this morning. Let's go ahead and take a look at the specific breadth numbers now. And over here on the main part of the Thinkorswim platform, you'll notice I've got the index watch pulled up with the S&P 500, and we had 348 stocks out of the S&P 500 close in the green today. That's good for approximately a 70% hit rate there. So, we've had a few of those recently. This wasn't an overwhelming day. Remember, sometimes when we have such aggressive trading in one direction or another, we get those 90% types of days. Today was not one of those, even though it seemed like it could have had the potential of that at the beginning of the session here today. So again, with that kind of midday sell-off there, some of those companies that were starting the day in the green, managed to close in the red. So there were 151 stocks in the red today, despite the elation from the bulls right out of the gate at the opening bell. Let's go ahead and now take a look at some of our charts, starting with our 4 grid here. This is chart 4B for those of you that are premium members following along at home. One thing that I find interesting about today's setup, or today's 4 grid here, is that you'll notice that all 4 of the daily range labels at the tops of those 4 charts are orange. Remember, those labels will be either orange or blue. If they are orange, it means it is an aggressive day where today's trading activity outpaced the typical trading activity or average true range. And if it's ever blue, it's the opposite, meaning that it would have been a quiet day. You can kind of think about like the color orange representing fire, like it's on fire, it's red hot type of a thing, and that lighter blue kind of representing ice cold, like it was a quiet day where there wasn't much activity. So today was one of those days where volatility was on fire. It was all over the place. What's interesting about it is not necessarily that we got that. We've had plenty of days in the past where all 4 of them have had those orange colored labels. But what was interesting is that today was a day where all of our indices closed higher. A lot more times is the case where we have really aggressive trading with a really wide range on a day when the stock market collapses, and we have really aggressive selling associated with it. So today we certainly had the bears step in after the opening bell, but it wasn't one of those that ended with horrible losses or anything like that. So that made today a little bit unique there. To put that into perspective, I did see a stat on Twitter earlier today that was talking about the times throughout history where I think it was the Dow that had been up 2% during the morning session, give back all of those gains and close lower by the day. Now, again, the Dow did manage to close just barely higher today by 0.3%. But when this tweet was coming through, it was a little bit before the stock market had closed. And if we had closed in the red here today after being up 2% earlier in the session, it would have only been the 5th time since 2009 that that's happened. So that gives you a sense of how rare today was. It was an extremely wild day when we had the massive gap ups. And you'll even notice that looking at the candles looks a little bit different here today. Notice the S&P 500 candle, and it's even more emphatic down below here with the NASDAQ composite candle. You don't see these types of filled in candles very often. You see them on the downside plenty, but it is fairly rare to find the up days with those filled in candles. You had a few examples of that, like right back here on August 18th. I'm sorry, that was October 18th. You had somewhat of an instance of that on November 15th and November 17th as well. But today's, in comparison to those 3 that I showed you over there, was much more dramatic. Those candles can only be formed when we start the day with a massive gap up, and then we spend the rest of the day selling off to still close higher, but well off the highs of the session. So it requires a gap up out of the indices in order to achieve that type of looking of a candle, and that just doesn't happen all that often, right? You need an extremely moving type of economic report or data that comes out in most cases in order to cause a gap on an index like that, especially to this degree. This was a massive gap. On the NASDAQ, we closed yesterday at 11,143, and then this morning we opened at 11,542. So, we're talking like 200 points or whatever it was, right? It was a massive gap higher there. And then we ended up closing up by 100. So we gave back, approximately half of that gap here today on the NASDAQ. So an extremely wild day. Now, despite that, you will notice that another thing that may catch your eye is that all 4 of these charts now have a green background color. Right there on the S&P 500, right there on the Dow Jones, right there on the NASDAQ composite, and right there on the Russell 2000. And what that means is that today's move, despite being not quite as resilient at the end of the day as it was at the beginning of the day, was still enough of a push. And of course, this is combined with yesterday's move as well. Yesterday was a good bullish day as well. But those two things together were able to basically pull or bend those green intermediate lines in the market forecast technical indicator higher, right? That's the only way that could happen, as long as it's not in the upper reversal zone. Remember, if it's in the upper reversal zone, it doesn't matter if the green line is going higher or lower. We would consider it to be bullish. But if it's between the overbought and oversold zones, then you need to see it bent higher. And with yesterday and today's 1-2 punch in the stock market to the upside, it was enough to turn these green lines all back around. And remember, prior to today, that wasn't the case. That's why prior to today, we had these pink background colors, because those green lines had rolled over. So that was kind of interesting about today as well. Even though we've closed well off the highs on all four of our indices, all four of them on the same day went from bearish postures to bullish postures. Now, having said that, there are obviously different ways to discern between the indices, and of the four, I would say that Russell 2000 is the weakest of the four, and the dead giveaway there is, notice that despite its background color changing to light green, because this green line kind of just ever so gently was pulled higher, but it's still below the indicator's 50th percentile. But despite that, the index itself actually closed below its falling 30-day moving average. That's somewhat rare to see that happen, where the posture went weakly bullish on a day when the stock actually closed below its falling 30-day moving average after being well above it earlier in the session. So it's pretty rare to see that type of a situation. Basically says that there's more conflict with this chart than there are with the others. It's not quite as clear cut in that particular case. And you can see that there was a nice long upper shadow there on the Russell 2000. Generally, that is more of a bearish feature, but oftentimes with these types of candle formations, you do need confirmation on the next day. So, that could basically be eliminated tomorrow if the markets are just roaring higher and we're breaking out above, this high back here in mid-November, then all bets are off. But tomorrow, if the markets do sell off, we will look at today being a very important day with, that acknowledgement that the bulls just simply could not hold on to their gains on an intraday basis, right? The bulls were able to push it up pretty high during the day, but the bears were able to then sell it back down by the time we closed. We were still up on the Russell 2000 by 0.76%, but we were trading closer to the lows of the daily range than the highs of the daily trading range, to put that into perspective there. So that's the only one that has the red moving average, telling us that price is still below a falling moving average, just like it was yesterday and the day before. Today, in the beginning of the day, it didn't look like that would be the case. Remember, if it would have closed above the moving average, that moving average color would have flipped back to yellow in that case. If it would have closed way up, it's possible the moving average could have even been pulled higher, and who knows, maybe it could have been painted green. That would have required a very big move, but just to remind you of how these different lines work here on this 30-day moving average. So that one does stand out as being the only one of these four charts that has that red moving average. So that's the one that I would personally consider to be the weakest link out of these four that we have here right now as well. That's something we've been talking about in my factor-based swing trading classes here in the last couple of weeks as well, as the low size factor has been the worst on the factor selector. And so this kind of proves that point, because of course the Russell 2000 is the closest major index that aligns itself with that low size factor. In terms of which of these appears to be the best, it's tough. You could probably get away with saying that it's the Dow Jones Industrial Average still. First of all, remember, it's been the Dow that's been the leader ever since this market bottomed back in the fall. And so, the path of least resistance would be to say that the Dow is continuing to be the leader. You could also use the intermediate reading itself to help identify that. And you'll notice that the Dow continues to have an intermediate line at 72, whereas the S&P 500 is at 67 and the NASDAQ is at 64, so lagging it to just a degree there. So, it's not quite as obvious today, I wouldn't say, that the Dow is the leader as the way it was when this rally first started a couple of months ago. Now you're kind of really seeing more participation out of this S&P 500 itself. Notice that both of them today hit multi-month highs. Right? These are 3-month highs here, so they're not yearly highs, but that high label is above today's candle on both the S&P 500 and the Dow Jones Industrial Average, whereas that is not the case with our two charts down below. The NASDAQ had its 3-month high exactly 3 months ago, and the Russell 2000 had its 3-month high back here in mid-November. So I would say that it's one of the top two charts that's our leader, and the tie goes to the runner, so to speak, with the Dow Jones Industrial Average. That's the one that got running down that baseline the quickest, the fastest, the soonest, and therefore it gets the tiebreaker in this particular case. I didn't mention it specifically, but the NASDAQ was up 1.01% here today. So it was our leader on a one-day basis, despite giving back more than half of its opening gains there. And then the Russell 2000 was up 0.76%. S&P was up 0.73%. So those two were nearly tied. And then the Dow was today's laggard, up only 0.3%. And normally that's kind of the traditional ranking there, by the way, as well. Whenever we have a big risk-on type of a day, it is usually the Dow that lags because that's where you've got your big blue chip types of companies. So that kind of generalization did continue to hold true here in today's session as well. Let's go ahead and take a look here at our 3 green arrows charts now. And so let me go ahead and pop that up. This is chart 4D. And as we're looking at this chart, you'll notice that we have one chart that continues to have a 3 red arrow signal, and that is the Russell 2000. Again, that was nearly broken today had it closed above its moving average, but it was not able to, so it basically retained that prior red arrow, and you do still have a red arrow on the MACD and on the stochastic down below. On our other 3 charts, we have a mix of green and red arrows, so none of these charts have 3 green arrows, just one of them has 3 red arrows, and the other 3 have a mix of both green and red arrows because the other 3 charts are all trading above their 30-day moving averages, but they have red arrows on the MACD histogram and on the stochastics. Let's take a look here at our longer-term 1040 crossover chart as well. And remember that these are longer charts to look at. These are 3 years in length that you're looking at here. And each one of the candles that you see represent 1 full week of time. And as you can see, the Dow Jones Industrial Average now has what we would identify as a golden cross. Remember, when you hear that terminology of golden cross versus death cross, a lot of times on CNBC and other places, they'll be referring to the 50-day moving average and the 200-day moving average. This is pretty much the same thing. It's just that we're using weekly candles with it instead of daily candles. So like the orange line represents the 10-week moving average, and the blue line would represent the 40-week moving average. But obviously there's 5 trading days traditionally in every week, so if you take 10 times 5, that's where you get your pretty much a 50-day moving average, and then 5 times 40 would be effectively your 200-day moving average. So whether you're using daily candles or weekly candles, these crossovers generally tend to happen in about the same time period. And right now we do have a bullish crossover there, a golden cross on the Dow Jones Industrial Average, but we're not quite there on these other 3 charts yet. Perhaps we can get there if the markets do respond positively to Jerome Powell tomorrow and we finish the year strong. But as of this moment, that would be another way to recognize from a longer term perspective that it is the Dow that is currently our leader in this market. Let's go ahead and pop on over here to the internet. I always like to get a chance to say thank you to those of you that help support these presentations. 105 of you clicked like for me the last time I did the video on Thursday, and I appreciate each and every one of you. Remember that it takes David and I at least 3 hours to do these videos all in. And so we truly have to ask ourselves each and every day whether we can afford to cut out that portion of our day as busy business owners in order to do a free video. And so many of you recognize the challenge that we have from that perspective as well. And you're more than happy to click like for us there, since it doesn't cost you anything and it only takes 5 seconds out of your day. Hopefully more of you will be willing to do that as we move forward, because that allows David and I to have some sort of a motivation to do the videos, to get the word out about our business, right? If we were just talking into the wind and nobody was listening to us, it really wouldn't be worth our time whatsoever. So we would highly encourage you to help support us. The best way for you to say thank you to us is just simply click like for us there on Twitter. I'll do the same deal I do with you each time, which is as long as we're up and over 100 likes, I will plan on doing a full-length video the next time I'm scheduled to do it. Remember, I do videos on Tuesdays and Thursdays. David does them on the other days. So if you can get me to 100 likes by the time I'm scheduled to do the video again here in 2 days on Thursday, I'll be more than happy to do a full-length one for you with extra analysis on the 12 grids and a trade application example and all of that. On the other hand, if you think that these videos are a little bit too lengthy for you and you prefer that I just cover only the indices themselves, then don't click like. In that case, if we're under 100 likes, then I would just plan on doing a 15-minute version of the video with no trade application example. So it really depends upon all of you collectively what you prefer there. Let's do some shout outs while we're here. Thank you to Jayesh, and thank you to Robbie and Michelle and Damon and Alchemist and Phil and Fun Jonesy and Paul and Claire and Topline Invest and William and Norm, Dennis, Ken, Yair. We've got John, we've got Jim, we've got Fred and Keolia, and we've got Carlisle and Lucius and Curdy. Too many to go through all of you, but I do appreciate all of you guys. I know many of you do this as part of your routine, part of your routine when you're watching the video. You just get your like out of the way while you're doing that, and we do appreciate that. Thank you so much. Let's also take a look here at our sector selector. A reminder that the sector selector gets put together on Friday evenings. For those of you that are premium members, I do send out a Telegram note to let you know when the most recent rankings are done for both that and our stock selector tools. I do both of those pretty much at the same time, Fridays, after I get all of the data and statistics needed for them. And this one has a little bit of a different feel to it. I already posted this on Twitter over the weekend, so those of you that follow me on Twitter, even if you're not a premium member that would attend my top-down trend trading class on Monday, probably know this already, but for the rest of you, the big news here this past week regarding this tool was energy fell all the way to dead last. So we went from first to worst in basically 3 weeks. Sometimes you guys have heard me mention that trading energy stocks is like riding a bucking bronc. If you're into rodeos, which I'm not, I did grow up in South Dakota, so I've been around a few rodeos in my day. I am enjoying that show Yellowstone on Paramount Network as well. I'm sure some of you have checked that out. It's a great show. So maybe I'm in my rodeo mindset right now, even though I've never participated in one. But it is hard to stay on a bucking bronc because it's a very volatile experience, and you're lucky if you can stay on them for 8 seconds. And so energy, as you can see, after being at the top as long as it was, just bucked that cowboy or that cowgirl off of the horse right there, and now fallen right to the ground. So it's a wild one. Who knows if we can get the mojo back? Obviously, a lot of that depends upon what happens with oil prices moving forward. But that was somewhat noteworthy because of how quickly energy went from first to worst. With most of these other sectors, that's not really a big possibility. Most of the other sectors are pretty diversified, where it would be hard to go from first to worst or from worst to first in just 3 or 4 weeks. Most of them kind of have to meander their way to the extreme levels. But energy, because it's largely driven by sentiment and by geopolitics and by the price of crude oil, a lot of those things that can't be controlled by the managers of ExxonMobil or Chevron or any of those oil companies, you do see much more extreme volatility associated with them them, those are stocks that tend to have very high betas. On the flip side of that conversation, in terms of not focusing on who's on the bottom, but who's on the top here, healthcare had a very nice move and is now in the number one position. Now, as I was mentioning to my students on Monday morning, I'm not sure that they should desire to be there given the pattern that we've seen here more recently. And what I'm referring to there is, back here on the final week of November, industrials became the number one positioned sector and took out energy, which had been up there for several weeks. But you'll notice that silver ball was only up there for 1 week. So it got to the number one position for the first time in many months, and then it could only stay there for 1 week. And then it was replaced by consumer discretionary. And guess how long that lasted? Yeah, you guessed it, 1 week. So here we've got healthcare up to the top of the rankings for the first time in multiple months. And we shall see if it's got the stuff to stay up there for more than a week. What we saw here earlier today on the heat map doesn't give us a whole lot of confidence in that regard because there were a number of healthcare companies that finished the day lower. But healthcare in general is a little bit of a different type of a sector where it has both growth and value or defensive types of characteristics, right? You think about the major pharma companies out there much differently than you think about the scrappy up-and-coming biotech types of companies. So I would venture to guess that healthcare has a better shot of staying up at the top, but a lot of that will be dictated by how we trade moving forward after the FOMC announcement tomorrow. So we'll find out here soon enough. The other thing I would point out is that consumer staples did make their way into the top four. Top four is what we usually look for with our trend trading class in our Monday, our Monday morning class that many of you attend. And so we put a little bit extra emphasis on it for a momentum class, right? For dividend growth investors is the opposite. Then we would probably be more interested in what's happening at the bottom because that means those particular areas have higher dividend yields. But if you're trying to kind of play it on a relative strength basis as a trader, then these are the areas that have more juice behind their names here currently. And so it's not a great sign to see consumer staples up there in kind of that top four zone because consumer staples, unlike healthcare, are almost purely defensive characteristics, right? There's very little in the way of growth in that particular area. And so it's, a little bit of a fly in the ointment there that maybe this market rally that we've been witnessing still has a little bit of a challenge there. You'd like to think that if this was a rip-roaring bull market, that you would not have consumer staples still in somewhat of a leadership group like we see here currently. All right, let's get back on over to the main part of the platform, and let's take a look at some 12-grid analysis, starting with chart 5A. This is our asset class 12-grid. And as we pull this up, you'll notice that we do have 3 pink charts on the board. Those mean that they have bearish postures according to the market forecast technical indicator. And you'll notice right here in the lower right-hand corner, the 10-year Treasury yield really slipped here today off of that cooler than expected inflation number. And we are now looking at a 10-year Treasury yield of 3.5%. Remember, it was not so long ago when we were looking at a 4.33% Treasury yield back here at the end of October. So we have slipped basically 80 basis points in yield on the long end of the curve. Oddly enough, the short end of the curve has held up just fine, and that's why we continue to be in those kind of inverted yield curves types of the situations right now. And I still find the short end of the curve to be highly attractive right now with those yields in excess of 4%. So some of those opportunities have not been around for many, many years, now are showing up on our laps. And a lot of folks trying to take advantage of that. Now, keep in mind that when Treasury yields go lower, traditionally bond prices go higher, and that is the kind of experience that we had here today. Notice that TLT was up about 1% today, similar to the S&P 500 itself with that filled in candle. Notice that we've had actually back-to-back days on TLT with those filled in candles. Let me right click on this and maximize it so those of you that are on a cell phone can see that a little bit better. But notice that that is the only example in this 3-month time period of this chart where we have back-to-back black filled-in candle days there. And again, that is required, or it requires a gap higher to start the day and then a sell-off for the rest of the day, but to still close above the prior day's close. So in other words, still closes in the green like this one did today, but closes well off of its highs, because here's where it closed, where I'm circling. Here's where it opened in this other kitty corner part of that rectangle there. So fairly rare to see that type of back-to-back type of behavior where it immediately gives you the sense that it's very bullish, but then as the day goes along, it starts to make you second guess that bullishness. Like over here, you don't second guess it, right? These are black outlined candles where they're not filled in, right? This candle, this candle, this candle. There you're not really second guessing the bullishness because you're basically closing at the highs of the day. That's what you want to see if you're bullish. These types of candles you're not as enthusiastic about because it reminds you that the bears are still around and there's going to be a little bit more wear and tear taking place. You'll notice that the green line on TLT has rolled over a bit, but because it's still in the upper reversal zone above 80, we do still consider this to be strongly bullish. Nonetheless, this kind of back and forth type of behavior we've seen for the last week has started to take its toll on that green line down below. So keep your eye on that. This is the type of chart that can have major movement tomorrow upon that Fed announcement. With BNDX, which is our foreign bonds, it was somewhat of the same. We had a filled-in candle there. We actually only closed higher on foreign bonds by 0.02%. And then on the high-yield bonds, they did quite a bit better today. They were up over 1% today and did not close at close to the lows of their trading range today like the other two did. So it seemed like the high-yield or junk bonds handled things quite a bit better today. Remember that high-yield bonds tend to do better when it's a risk-on market environment, like we saw with stock prices rising across the board today. We also did find that oil prices rallied pretty furiously here today. Remember when I was with you last on Thursday, it was during this candle where I was talking about the oversold cluster signal on oil and how well the previous one reacted to that with basically a straight line higher for the first couple of weeks after producing that cluster. Here we had back-to-back clusters, but we've now had 3 days in a row of upside action there in crude oil. It might not click back into an uptrend, but would it be entirely surprising if we got back up to this falling moving average? No, not necessarily. This is the type of asset that can move in a hurry under the right types of headlines. And so we'll keep our eye on that. Despite today's 2% move, which followed yesterday's pretty aggressive day in the oil market as well, we still have that strongly bearish posture because things had been so ugly with the selling in the week prior to that. So really we're just kind of gaining back about half of last week's losses, but still worth pointing out and taking note of there. Gold ended up having a pretty reasonably strong day as well. It was up 1.71%. We've been talking a lot about gold in this very presentation here for the last month or two. I've mentioned on more than one occasion that, I think there's a legitimate chance that gold is truly changing its trend here right before our eyes, right? And that's kind of different than the way I would talk about oil, right? The assumption on oil is that this will not be a trend-changing move. But because gold basically went straight up in such a short amount of time, any of the natural givebacks that it has along the way can't even get it back to its moving average. And so that almost ensures that it stays in an uptrend, at least in the beginning. As long as it can hold it, then it's got a chance to actually have a pretty strong 2023. So let's keep our eye on that story, as both gold and oil were up nicely today on a day when the US dollar was down yet again. Dollar was down about 0.88%, and as you can see, it did close at near the highs of its range, but because it gapped lower to start the day, let me right click on this, you'll notice that we breached those prior support levels on the dollar. So despite it closing up here, even though it opened down here, which is maybe a little bit of embedded bullishness in the trading session itself, it still closed well below this support zone. Remember, sometimes you get like a breakdown retest type of a thing. and it's like more of a head fake. Today, I would not classify that as what's happening here with the US dollar. This is a continuation of this downtrend that we've been talking about ever since really this candle. I remember having that conversation with you guys saying, I still want to give it a little bit of, wiggle room in my mind to kind of work its way through this concern because it had a similar type of a setup back here. But when we started failing that there, it was like, okay, this is now different, right? And as you can see, ever since we broke kind of this support level here, back in the first part of November, it's just been a really painful trade to the downside for the dollar. And remember, that's a good thing for the rest of the financial assets that are out there, generally speaking. As I've mentioned plenty of times, I prefer it personally when the dollar is weak. That is typically a time when stock prices have an easier time to go up, particularly the types of companies I'm generally interested in as a dividend growth investor, because many of those types of companies like your McDonald's and Coca-Colas and what have you, those companies do more business outside of the United States than inside of the United States. So it's helpful for them with the earnings that they report and what have you when the dollar is weak. And it's also helpful to purely foreign companies that are tradable here in the United States. In fact, we bought a foreign healthcare company in my top-down trend trading class yesterday morning for that very reason. We want to start kind of participating a bit more in foreign individual stocks if they're starting to click into their uptrends here. Because remember, foreign stocks have underperformed for years and years and years versus the U.S. market. So who knows? If they can get their wheels revving here, they could very well have a long amount of a runway in front of them in terms of outperformance versus the U.S. markets because they've underperformed for so long looking backwards. So, keep your eye on that possibility. Obviously, there's a lot more U.S. stocks available to us than foreign stocks, at least those of us that live here in the United States. But it doesn't mean that there are no foreign stocks out there. There are plenty. In fact, on the stock selector tool this week, as I was mentioning to my class yesterday morning, the top 3 stocks on the stock selector tool, which ranks things by a relative strength perspective, where we look at 1,000 different companies, the top 3 out of those 1,000 are all Chinese companies this week. So, there are definitely opportunities outside our shores. And the longer that the U.S. dollar can stay weak, the greater the chance is that those opportunities will have legs to the upside. You will notice that today that the foreign developed stocks did close higher than the S&P 500. However, EEM did have a day of underperformance. They actually closed lower today. They gapped up to start the day like everybody else, but they ended up actually closing below the zero line. And EEM had a really strong move right here at the beginning of November, much stronger than what we saw out of EFA. But it does feel like things have changed just a little bit here in the last week, where you're kind of seeing this chart slumping over just a little bit. Whereas with EFA, that's Europe and Australia and Japan and what have you, it actually broke to multi-month highs here. So it does seem like there's that possibility that maybe there's been a baton pass taking place here. It was EEM that was leading us higher here a month or so ago, but now it almost seems like the developed foreign stocks are assuming that leadership position. You'll notice that they hit a new 3-month high today, and not even SPY and EEM can make that claim, at least on a closing price basis. So anyway, keep your eye on that possibility. EFA looks pretty strong, and that is where our trend trade came from that I had mentioned before in our class yesterday. It was a European healthcare company. And so there are quite a few European healthcare companies out there that are available to be traded here for Americans. I think that's pretty much what I wanted to cover. Let's just quickly mention Bitcoin. Bitcoin had a very good day. It was up 3.5%. Of course, if you've turned on the news today, you probably saw that Sam Bankman-Fried is finally in custody. It seems like it took a little bit longer than it probably should have. Nonetheless, he was the head of FTX exchange that, of course, is now being accused of fraudulently using client access assets to trade off of for their own accounts. And so he is now in custody. And so it was kind of an interesting day for Bitcoin to do so well. Perhaps part of it was just because today was a risk-on day. And as most of you should be aware of by now, Bitcoin is a risk-on asset. And so when the animal spirits are alive and well, all else being equal, Bitcoin should be up on days like that. And it was today. But it does make you wonder as well if Bitcoin is, benefiting from the fact that more regulation is coming into the system and trying to take away the bad actors. Remember, FTX is just an exchange where you trade cryptocurrencies. It is not necessarily a cryptocurrency itself, although I do think it has some tokens associated with it, but that's not the main part of its business. So maybe Bitcoin is in a moment where it's trying to prove that it's the strongest of the remaining cryptocurrencies out there, and that there are a lot of sketchy characters involved, like your SBFs out there, and instead maybe you should trust the currency, not the people that are representing them. So who knows, maybe I'm thinking about that too much. But point is, it was a pretty strong day for Bitcoin. We are now back to a weekly bullish posture. However, we stayed right underneath that falling 30-day moving average. So until we can break above that and stay above it for a meaningful amount of time, I think there's still going to be a lot of people that are quite hesitant towards that nascent asset class there, as there's just a little bit more speculation that is required for that. And this isn't really the era or the moment in time that seems to reward a lot of speculation. This is seeming to be a moment in time that is rewarding the tried and the true, as I talked about so often here with my dividend growth investing class today. And by the way, we did focus on the consumer discretionary space in the DGI class today. So for those of you that are premium members, you can check out that recording on our website. Also, I got a question from one of the people that took advantage of our Black Friday sale here recently, because he was wondering, if the recording was ready to be watched yet. And I had mentioned that I had just gotten out of class a half an hour prior to when he had emailed us, and our recordings are not available within the first half of an hour. There's a process that's involved. We actually have to get the files sent back to us by WebEx and then upload them into YouTube and then post them to our calendar. So normally I try to get those things posted as long as everything is going as planned within a couple of hours after the class is taught, but it's not going to be available a half an hour afterwards. That's just too quick. So I know not all of you might know that, so figured I would mention that here in case some of you might be newer to our premium offerings there as well. Anyway, let's go ahead and take a look at our sector 12 grid right now, and this will be chart 5C. And as you can see, we have just one pink chart remaining, and guess what? It was the only pink chart that was on the board a couple of weeks ago as well, and that is energy. That's your riding the bucking bronc experience there with energy stocks as well as oil itself. And you can see that despite it rallying the last couple of days, it does remain with the strongly bearish posture here, and it's the only one that can make that claim. When I was with you last week, there were other sectors that were joining it. So with the 2-day rally that we've just experienced, those other sectors have now gone back to those bullish postures. I remember one of them as an example would have been like materials right here, or perhaps industrials. So with the 2-day rally that we're in the midst of right now, that was enough to switch that posture back to bullish for those. So now only one that remains with the bearish posture is the same one that I had mentioned on the sector selector that is dead last in that regard as well. So those two things kind of confirm one another. Now again, I will remind you that we did have an oversold cluster signal on XLE, just like we had an oversold cluster signal on oil prices themselves. So don't be surprised if we do have a quick little reversion to the mean type of a move. But then the question is, where do we go from there? If we get up to this falling 30-day moving average, a decent chance that it uses that as resistance and bounces down and away from there. Okay, so keep that possibility in your mind as well. Otherwise, the charts are looking quite good, right? It's kind of funny to say that. Here we are getting close to closing out the year 2022, and our charts actually look pretty good, even though this year has felt like a disaster in many different corners of the market. I was spending quite a bit of time in my dividend growth investing class talking about that today, because I was mentioning to them that all of us dividend growth investors should be thanking our lucky stars. That class portfolio is actually up on the year, and that's not even including the dividends that would have been paid into it. And so those areas have definitely benefited, especially on a relative basis. Not all dividend stocks are up, of course. There's plenty that are down. But on the whole, if you were to look at something like NOBL is a good ticker symbol to look at for the Dividend Aristocrat list. So let me just kind of give you a large chart here and look at NOBL. And you'll notice that NOBL is up here near the 3-month highs. It's up about 7% over the last 3 months. And even if you were to switch this to like a 1-year chart, you'll notice that it's only down 2.5%. And if you were to add back in, the 2 to 3% dividend yields, even this ETF, where you don't have to be a genius and pick the right dividend stock, this is basically a break-even performance year over year. At the exact same time, you're looking at, let's say, the NASDAQ with the Qs being down 26% in a year. So with the aristocrats, you're basically break even. With the NASDAQ, you're basically in a bear market, right? That type of difference is what we are witnessing in this year. It has been quite remarkable. Normally, markets are much more correlated than that, but this year has been one for the ages, that's for sure. Anyway, one of those areas that is oftentimes associated with dividends is, of course, real estate. And they had a very strong day here today, as you can see in the lower right-hand corner. Real estate was our leading sector here today, up 2.2%. Utilities were up 0.3%. We had communications up 1.7%. Technology was up over 1%. So some decent movers there. In terms of who the worst performing sector was today, it was actually consumer staples. Remember when I mentioned on the heat map that, Procter & Gamble and Walmart and some of those companies were being left in the dust on a risk-on type of a day. That's kind of your proof in the pudding right there. Staples on the whole were down 0.14% today. They were the only sector that was lower today. All the rest of the sectors were up. But again, it was real estate that led the way higher here today. With communications being second best performer today. And that'll be a good segue, because my trade application example for the day is going to come from the communications sector itself. And remember, communications had been out of favor for a very long time. We talked about that endlessly looking at the sector selector earlier, when it was this orange ball here represents the communication services sector, was dead last. And this isn't even telling the full story. Earlier than this 3-month rolling graphic will show you that communications earlier this year were dead last for many, many weeks in a row. So it's been a really tough year for communications because of stocks like Meta and Disney and some of those that just cannot seem to get going. And one of those companies is Alphabet. So let me explain what it was that I did as our trade application example here today. A friendly reminder that our trade application examples are done while the stock market is still open. And then I do send out those Telegram notices to our premium members to let them know what the trade was that I did, what the strike prices were, what the fill prices were, all of that kind of good stuff with the details there. So that way it gives those of you that are premium members a slight benefit to being a premium member of Market Scholars, as opposed to just learning about the trade on the free video later that night. And that allows you to decide if you wanted to consider a trade like that as well. Obviously, we don't recommend it because we can't. We're not licensed advisors, but obviously many of you will consider the various trades that are being presented, and some of them you'll pass on because they're not too suitable for you and you don't agree with them. Others may jive with what exactly it is that you're thinking as well, right? And everything in between. So in the end, it just offers up more choice for all of you who are our premium members. So don't forget about that nice advantage as well with our Telegram app. Anyway, let me kind of explain here to the free audience what it was that I did. I did what's known as an iron condor sale here today for Alphabet/Google, ticker symbol GOOGL in this case. Remember, this is the Class A shares as opposed to the Class C shares. Not that it matters all that much, but just want to make sure we're all on the same page. Anyway, as you can see with this chart here, Alphabet has really kind of been stuck in no man's land for quite some time. Unlike the stock market that's rallied, this one has only managed to get back up to its moving average itself. Notice that 3 months ago, had you had the opportunity to put money into either the S&P 500 or into Alphabet, you'd have been better off in the S&P 500. This dotted line up here will show you the pathway of that, whereas Google's candles are below that, meaning that it has underperformed over this last 3 months. And that by itself is somewhat noteworthy. Of course, the last 10 years or so has largely been defined by the FANG stocks, Google being one of them. And more times than not, Google had been an outperformer versus the market. But right now, we're in one of those periods where it seems like the sheen is off of those mega cap tech-oriented types of companies that are out there. So this one's been more in a holding pattern, while some of the other areas of the market have been bouncing up a little bit more aggressively. And you'll notice that we do have a green moving average today, whereas yesterday it was red. So yesterday price was below a falling moving average. Today, because we bounced up 2.5% on Alphabet, it was enough to pull that moving average up and us to close above it. So, that was kind of interesting as well, and really kind of tells the story of the conflict between the bulls and the bears here with Alphabet. For those of you that are newer and maybe you don't have as good of a feel for options trading yet, an iron condor, when you're selling it, is basically a way for you to try to take advantage of a lack of directional nature of a chart. Right? Most of our other trades that we set up are directional. You want to be bullish on a stock, you want it to go up. You want to be bearish on a stock, you want it to go down. But there are plenty of options trades out there that can actually make you money if there is no direction. In other words, sideways type of behavior, and selling an iron condor is one of those. So that's what I opted to do here today in this kind of trendless chart that we are staring at here in front of us. And we'll see what tomorrow brings, of course, with the Federal Reserve announcement. Maybe we'll get more clarity on where the market in general wants to go. But for right now, this seems to be a pretty good range that I've selected for the trade. Typically, we try to sell somewhat around a 20 delta on either side. Remember, with an iron condor, it has 4 different strikes. And so liquidity is very important. We had this conversation yesterday in my Options for Long-Term Investors class. In that class, we sell puts on dividend stocks that we want to own for the long term. And I was mentioning to them that liquidity is not particularly important for us as put sellers, assuming that we are willing to accept assignment on the companies that we are selling puts on. But in an iron condor, that's not the case. Here you do need liquidity because you're dealing with 4 different strikes as opposed to just 1 strike. So the illiquidity gets compounded by 4 times. And then on top of that, you may need to get out of your iron condor trade by buying it back and flattening your position. And therefore, you need the liquidity not only when you enter into the position, but you also need the liquidity when you exit out of the position. Now, you can let your iron condors expire worthless on expiration day as well. So I don't want to make it seem like you wouldn't, but I would say that in general, I would let my sold put trades go till the expiration day much more often than my iron condor trades. And so liquidity is quite important for these types of trades, and Google offers that for us, right? It's one of the biggest companies on the planet, and tons of people are trading options on it. So that's kind of a nice aspect of it as well. Now you'll notice that there are 2 different lines that are drawn on this chart, and those 2 lines are represented by our break even on our trade. So in order to find the break even, you have to figure out what your credit is, and then you either have to subtract or add it to the strikes that you are selling. So on the top side, where we effectively have sold a bear call spread for that part of the iron condor, our break even price is 108.10, and on the downside, which is effectively selling the bull put spread part of the iron condor, our break even is 86.40. And you can see how those lines have been drawn there, where we've largely traded within that range for the full 3 months of this chart, with the one exception of this day right over here on November 3rd, where it kind of broke it to the downside for 1 day and then immediately went back above it the very next day. So with the exception of that one random day right there, all of the other candles have traded within the range of where I need this stock to stay within between now and the middle of January. That is the monthly contracts that I selected in that case. And again, if you need the specific strikes, because this one was a little bit weird, where I had to do the strikes a little bit different because there were some strikes that did not have dollars between the strike prices. So I did a little bit differently than I would have liked to. So if you need the specific strikes on that, remember that's a perk that you premium members would get by checking out the Telegram app there. But that's the basic idea, selling an iron condor on Alphabet with the hopes that it continues to trade sideways for the next month or so, just like it has for the last 3 months. And if it does, then I should have a chance of making about a 30% return on my risk that I put on for this particular paper trade. Okay, so that's what I had for you here tonight. A reminder, tomorrow's a big day, if you didn't know before, right? And of course, I'm just joking because most of you are well aware of that. It's been on the calendar and circled on the calendar for quite some time. This will be the final FOMC interest rate decision for the year. And we shall see if it's 75 basis points, if it's 50 basis points, and we'll see what Jerome Powell thinks about the future as we head into 2023 with interest rate policy as well. So I hope you got value out of checking out the video tonight. I thank you for watching it. I thank you for all the likes on social media and all that kind of stuff. And again, if you want me to do another full-length video for you on Thursday when I plan on doing this video again, just go ahead and click like. As long as we're up and over 100 likes, be more than happy to do that, including a trade application example like I just showed you here with Alphabet. So until next time, I want to wish you all the best of success with your trades and your investments. Goodbye for now.